Our next speaker is the chief economist at Freddie Mac. Did you get in the password?
Yep.
Okay, he's all ready to go. He's a talent. He leads a talented team of researchers in providing insights and analysis on economic trends and policy issues affecting Freddie Mac and the housing market. He arrives at Freddie Mac after 11 years at CoreLogic, where he most recently served as vice president of research and deputy chief economist. His responsibilities included producing original research and advising clients, regulators, policymakers, and investors on real estate and mortgage market trends. As a compelling spokesperson with a unique ability to translate complicated subjects, that'll really come in handy, he is regularly quoted in national, local, and real estate trade media outlets. Prior to joining CoreLogic, Sam was a senior economist at Fannie Mae and an economist at the National Association of Realtors. NAR! He holds a master's degree. NAR! He holds a master's degree in network economics from Georgetown University. Oh, he's smart, too. And a bachelor's degree in economics and finance from George Mason University. Please welcome Sam Khater.
Alec, thank you. Cheers. Good morning, everyone. I'm delighted to be with you this morning. I want to thank Jeff for the invite and Tony Hutchinson at Freddie Mac. So I'm going to tell you a story about the economy. So the economy is the best and fastest growing economy we've seen over the last 20 years. The labor market is extremely tight and is at near historic lows in terms of unemployment. But it's not translating into higher wage growth. And that, I'm going to talk a little bit about that because it's a little bit concerning from an economic growth perspective and from a home sales perspective. But the hot economy is driving up inflationary pressures, and we're seeing that mortgage rates are rising. And the impact of that has been felt in the home sales market, where we've seen home sales really sort of move sideways. They began to move sideways in late 2017, and then have begun to decline a little bit in 2018 so far. And then I'm going to talk a little bit sort of about longer-term trends and the fact that the economy is on good footing right now, but a recession is on the horizon in a couple of years. So if we look at economic growth, it's currently running at about a 3% rate. That's a one percentage point higher than the long-term average, which I've plotted on the chart. And that's very strong growth given we're this late in the cycle. If you look at 2005 and 2006, a year and a half before the recession, you can clearly see there was a slowdown in economic growth. That's not happening today, even though we're 9 years in the expansion. So second longest expansion ever. The growth has been choppy, but it's beginning to accelerate in the current year. We expect it to moderate next year and potentially hit a recession in 2020. And the main reasons are by then the Fed will be at their peak in terms of their hiking short-term rates. That feeds into higher long-term rates. Oil prices have been rising, and that's causing inflationary pressures. Oil prices currently are at 4-year highs, and the Fed is sort of an inflationary hawk, and they worry about inflation very much. And so the risk is that they may sort of accelerate their raising of the short-term rates, which feeds into long-term mortgage rates. If we look at the job market, it's a great story. So the unemployment rate is currently 3.9%. That's the lowest since November, December of 2000. And then when you go further back, the last time unemployment rates were this low was in the late 1960s and then the early 1950s. So we're talking about historic lows that we're seeing. The number of open jobs is more than the number of unemployed people in the U.S. That's never happened before. And so the labor market is extremely tight, and we're seeing all kinds of shortages all over the industry, particularly in the construction market, which I'll come back to in a minute. But that tightness in the job market is not really yet translating into stronger wage growth. If you look at wage growth here, it's running at about 2.9%. When you compare it back to 2007 before the recession, back then it was about 3.5%, and the labor market today is tighter than it was back then. So we should have stronger wage growth than what we're seeing. And this is a little bit disturbing. So I want to go a little bit deeper into this and take a look at two fast-growing segments that we're sort of well aware of. First, in the upper left-hand quadrant is the employment growth for warehousing. So think of your e-commerce logistics type jobs. Those jobs are booming. You can see that in this left-hand side chart that employment growth is at or near the highest level since 1990. And then take a look at food manufacturing down here in the lower left-hand quadrant. So food manufacturing, the best way to sort of describe it is it's a term by the Bureau of Labor Statistics that describes jobs that involve the processing or getting the food to you, to the retail consumer. So think of the farm-to-table movement type phenomenon, or folks eating out. The percentage of folks that eat out has really risen quite a bit over the last few years, and that's led to a surge in job growth in this segment. What's particularly interesting about these two segments is that these are two segments that do not require a college degree. So they've been historically a source of good, well-paying jobs for the lower middle income class. And if you look on the right-hand side here, I've plotted their earnings. And so historically in this logistics space, their earnings was 15% above average. The way you read this chart is 0 means this is the US median average for all jobs. And so it paid 15% more, even though most of these folks didn't have a college degree. And in terms of food manufacturing, it paid a little bit above average. But look what's happened over the last 27 years or so, right? So massive declines, and these two hot job segments are now paying below average wages. And so this is really sort of confounding to many economists, and sort of is one of the main unresolved questions today is why is wage growth so weak? And that's particularly concerning because it's really hurting certain segments of society. So here I've plotted the income growth for various income segments. And so the 50th percentile here is the median income. So when you see most statistics in the US by the census or other agencies, they usually cite this number right here. So $61,000 is the median income. It's grown about 35 to 40% over the last 50 years. We know all about the income inequality, which is happening here in the upper end of the distribution, right? So much more income growth for those that are making in the 170 or 180,000. What's interesting is that the lower middle income part of the distribution is the part that's really struggled the most. And so you can see even at the 10th percentile, you're not making, this is extremely low. You're in poverty here, well below poverty. The poverty line is about 25,000 in the US. But their growth is higher than that of the lower middle income part of the distribution. And so this is putting a lot of pressure on the home sales market, and is one of the main reasons why we've seen the demand for rent go up so much, and also the demand for entry-level housing. It's also one of the main reasons why home sales haven't recovered as much as you would think they would have. If you look back in the late 1990s, home sales were running at about 6% or 6 million sales. You see the run-up in the boom and the peak in 2005, up to about 8.5 million, and then the crash. That little sort of up-down movement around 2009 is the first-time home buyer tax credit. It began to steadily recover, but it only recovered back to about 6 million, low 6 millions, 18 years after 1999, right? So if we sort of adjust for the growth in the population, we should be running at about 6.5 to 7 million. So we're well below where we should be, and we don't expect home sales to increase any more than where they have been for a couple of reasons. One is affordability, and two, the lack of inventory, particularly on the affordable end of the distribution. And affordability is worsening for a couple of reasons. One is prices, which I'll come back to, but also mortgage rates. So mortgage rates hit a trough in this cycle of about 3.8% last fall. They moved sideways until January of this year, and that move up, that roughly 50 basis point move up between January and May was the longest sustained rise in mortgage rates since 1971. It's actually phenomenal, right? Because if you think back to the 1970s, mid-1970s, really late 1970s, mortgage rates have been declining the entire time, right? And so while mortgage rates are extremely low, they're beginning to rise, and they're rising because the economy is really hot and is generating inflationary pressures. I want to focus in a little bit on sort of the way consumers reacted or home buyers reacted to the rise in mortgage rates. So here I've plotted the year-over-year change in purchase applications demand. So the demand for purchase credit was rising at about 4% heading into this year, and it was sort of strengthening. And then it felt the impact of the rise in rates, which really sort of began in February. And so demand began to fall off as rates went up. But then when rates flattened and didn't decline, I think many fence sitters decided, hey, I'm going to jump in now because this might be my opportunity, because I don't think mortgage rates are going to drop. They may just continue to rise. And so we get this sort of little blip of fence sitters that jump back into the market. And then now we've settled into this pattern where it's now decelerated, and it's only growing at about 1% per year in terms of purchase demand for homes. And the main reason that sort of demand is weak is affordability. So here what I've plotted is a price. I indexed it to 0 in 1980, and I marked it forward. That's the blue line. And then median income in the green line, and I've also indexed it to 0 and plotted it forward. So you can see that between 1980 and about 2000, the two lines sat right on top of each other. And historically, there have been many, many studies that show over the long term, home prices and income should move up and down at a fairly steady pace, lock and step. You can clearly see here that home prices really accelerated and ramped up for a variety of reasons that are well known. The crash, notice how home prices didn't quite go below fundamental value. In cycles in the past, they would have dropped below fundamental value. They didn't this time. And then we've seen a surge in home prices relative to incomes today. It's not quite as high as it was in the mid-2000s, but it is a bit concerning. And this is one of the reasons why we haven't seen a recovery in home ownership rates. Home ownership has declined from about 69% at the peak in 2004. And notice also the home ownership rate peaked 3 years before the crisis really began. That should have been a warning sign to most people that home ownership rate is declining, even though the market was really taking off. And the home ownership rate declined by about 6 percentage points. That occurred primarily because we had 10 million foreclosures and short sales in that time period. And that's about 20% of all homeowners that fell out of the market and lost all their equity. And since then, the homeownership rate has recovered to 64.3%. What's fascinating is that what this doesn't show is right now the first-time homebuyer share in Freddie Mac's data is about 47 or 48%. That's the highest it's ever been. And so I think that homeownership rate number is going to continue to climb at least over the next year and a half, because the first-time homebuyer share in our book of business is very high. It's the same for Fannie. It's also true for Ginnie Mae, but Ginnie Mae's always had or FHA. FHA's always had a higher share of first-time homebuyers. Even though the homeownership rate declined by about 5 or 6 percentage points for the market as a whole, when you look at young adults, it hammered them. So the homeownership rate for 25 to 34-year-olds in 2006 was about 48%, and it fell to 37%. So huge decline. And what's interesting about this is over the longer term, if you look back to the 70s and 80s, the homeownership rate for young adults was declining. And so the pressure for young adults, or the challenges they had with being able to afford a home, really goes back decades, and now it's just gotten much worse. Not only is it causing affordability challenges for them in terms of being able to afford a home, but it's also causing them trouble in forming just their own households. And so this is a big deal for rental demand, sort of the housing ladder, rental demand, and then subsequent for sale demand. So when we look at the number of lost households over the last over the 16-year period between 2000 and 2016, there were 1.6 million fewer households formed than they should have been relative to the past. So we ran an econometric model and looked at what were the reasons for the lack of forming households, that 1.6 million gap that's on the end of the chart there. And the biggest single reason that stood out was housing costs. And the second reason was labor market outcomes, right? What I showed earlier in terms of the wage pressures. Some people point to sort of marriage and children, sort of the delayed marriage and delayed children decisions as causing this sort of decline in household formations. But really, and while it is a factor, these two factors are the biggest. But the one that's really particularly concerning is the lack of affordability. So not only is it causing a decline or causing homeownership rates not to rise as much, but it's also causing households to delay their formations. So why are home prices rising so much? There's one main reason, and that's there's a chronic lack of supply in the market, particularly for certain segments of the market. So here I've plotted completions in the U.S. So this is new supplies. It's single-family, multifamily, and manufactured housing. Over the longer term, it averages about 1.5 million. You can see that since 2009, or 2008, the highest year that we've had is about 1.2 million. And in 2017 and even in 2018, we're running at about 1.2 million. That's about the same as recession levels, which I've pointed out here in 1991 and in 1982. So it's remarkable that we are 9 years into an expansion, which is a long expansion, and we're still only producing new supply at the same rate as previous recessions. And so when you plot the cumulative shortfall of housing today, it's 4.6 million, the biggest gap we've ever had. If you go back to the mid-2000s, you can see we had an oversupply. So that oversupply is what led to the roughly 25 to 30% drop in home prices. But it pales in comparison to the shortage that we have today. And that's the main reason why home prices are going up so fast. And this is particularly concerning because the millennials are here, right? We've had a couple of discussions about millennials. So here I've plotted the number of people by each individual age cohort. So the way you read this chart is, this means there are about 4.3 million 18-year-olds in the U.S. And about 4.25 million 19-year-olds. So if you look forward here to the peak age cohorts for millennials today, the peak age cohort is 27 years of age, and there's about 4.8 million of them. This is one of the main reasons why the rental market has been so strong, right? We've got this sort of pig through the python that's coming in and has been supporting the rental market, but they're knocking on home ownership's door, right? So if you look at the median first-time homebuyer age, according to the National Association of Realtors, it's about 33. In our data, it's about 32, so they're about 3 or 4 years away from purchasing. When I was at CoreLogic, I looked at purchase applications data by age, and the peak on a per capita basis, on a population-adjusted basis, the peak demand for homeownership happens between 32 and about 37. And so we've got a really nice demographic tailwind coming. The problem is we don't have the housing for them. That's a huge, huge issue. And not only is there a shortage, but the type of housing that's being built, right? So if I go back, so if you look at this last bar for 2018, that's at about 1.2 million. If you break that down into the type of housing being built, we're no longer building manufactured housing at anywhere near the rate we used to. No longer building 2, 3, and quadplex units, which have been an affordable source of housing. We're no longer building stick-built entry-level housing, which is sub 1,500 or sub 2,000 square feet housing. Most of the new construction that's going up in that right bar, is either high-end single-family or high-end multifamily. And even those numbers are not enough. So there's really sort of a shortage, pretty much from the 65th to 70th percentile down of the income distribution. There's just not enough supply for any of those folks. So when we look at our home price projection, home prices in late 2017, early 2018 were running at about a 7.5% clip. When we had that run-up in mortgage rates, it's really caused it to decelerate quite a bit, and it's currently running at about 4.5% or so. So it knocked off about that 50 basis point rise, which is really not that big in the grand scheme of things, knocked off 2.5 to 3 percentage points in the home price growth space. We expect home prices to decelerate into next year, rising at about 3.5 or 4%. So we still think that despite all these affordability challenges, because of the lack of inventory, we're still going to see home prices continue to increase over the next couple of years. When we look at where the most rapid home price growth increases are, they're primarily in the sort of what I call open West. So places like Idaho, Boise, and Coeur d'Alene are knocking it out of the box. They're about up 14, 15% each. In Nevada, Vegas, Carson City, Reno, they're all up between 13 and 15% on a year-over-year basis. Keep in mind, with the run-up in mortgage rates of about 50 basis points, that means the year-over-year change in the mortgage payment for new buyers is about 20%. So think about that in context of the lack of income growth that we're seeing. What's also interesting is you're seeing, so we know the Southeast has been, or a good chunk of the Southeast has been growing for a while. What's interesting is take a look at Michigan, Wisconsin, and Indiana. They're running at about the same pace as California. And so I think that's just because those markets have just taken so long to catch up. When we look sort of longer term at demographic growth, which is really, when you look at the two main drivers of demand for sales, it's really incomes and population growth. And here I've plotted the long-term population growth rate by market. By long-term, I mean the 10-year, the average annual 10-year growth rate, and the one-year growth rate in green. Austin's been the darling in terms of generating the strongest population growth. So it's running at about 3.5% over the last 10 years. That's huge for any decent-sized market. It's decelerated quite a bit. You can see Raleigh was number 2 over the long-term, over the last 10 years, and Utah 3. If you notice the top 6 or so, they're all decelerating. And so what's interesting is a lot of the data the population growth data comes from the census, and that comes out with about a year and a half lag. I think a year and a half to 2 years from now, when they come out with these new population growth measures, it's going to show many of these sort of open West market, like a Boise, Coeur d'Alene, Reno, as the ones really generating, or Salt Lake City, Provo, as the ones that are generating the fastest population growth. And with that, I'll show you the slide you've all been waiting for. Thanks for your time.
Sam Khater. I think we're learning a lot today.